Good afternoon, good morning, good evening, everyone, depending where you are. Welcome to the fall 2021 season of the Future of Financial Information webinar series. So it's my great pleasure to kick off this season with Tony Cookson from University of Colorado Boulder, who will present, and Umit Gurun from UT Dallas, our discussant for today. So the topic is going to be echo chambers. So something that I guess all of us have encountered with respect to politics, the pandemic, or if you sometimes check econ Twitter, also economics. So it's an important phenomenon and also important for financial markets, as Tony will show. So just rules of the game. Tony will present for about 30 minutes, and we will then proceed with Umit's discussion for another 15 minutes. And the last 15 minutes is going to be open Q&A. But you don't have to sit on your questions until the very end. Please, if you like, put them in the chat. I will be keeping an eye on the chat so that no question is lost, and we can correct them at the end. And last but not least, after the 1 hour mark, we will stay for another 20 minutes for some unofficial chat. So also you're very welcome to stay and hang out with Tony and myself. So now, without further ado, please, Tony, the screen is yours for 30 minutes, and don't forget to unmute yourself. And thank you for being here.
Well, great. Thanks, Michelle, and thanks everyone for coming. Really delighted to present this paper. This paper is with Joey Engelberg and Will Mullins, and we've been working on it for a while, about as long as the pandemic has gone along, and so that's probably about 7 or 8 years by now. But I think we're definitely very excited about this because we think we have some interesting and interesting perspective on financial markets. So I'm going to start with a little bit of motivation. Motivation comes from a blog post actually by John Cochrane, and he calls this, with all the caps, the great unsolved problem of financial economics. That regularly we see tons and tons of daily trading volume in financial markets. In fact, if you add up the trading volume over the course of a year, it's regularly over the amount of GDP in US markets. There have been kind of a lot of explanations about why people trade so much, but a popular explanation for this kind of sustained amount of trading is that there's disagreement. And this is kind of a classical literature going back to lots of interesting contributions in the 80s and 90s. But then this kind of begs the question, well, why do investors disagree? And more to the point, how come they disagree so persistently? So a lot of these explanations of disagreement that exist in the literature, we'll talk about, like how information diffuses slowly through markets, but that's kind of taken almost as a given. You could say, information kind of diffuses from one person to another. If you disagree based on different information sets, that's kind of this kind of Harrison Hong perspective. But that kind of begs this question, well, why does it diffuse so slowly? Moreover, most of the volume is around public news announcements. If you think about kind of a rational updating classical model, where new information arrives, new information and plus kind of Bayes' rule, you kind of reduce the scope for disagreement. We, in this paper, propose a mechanism which causes persistent disagreement in other settings, think politics, religion, etc. Chevy pickup trucks is another example, but it's new to finance, and this is called echo chambers. So just to, if you haven't heard of an echo chamber before, or it's kind of a fuzzy concept, we're going to give you a stylized example to kind of tell you what it means in general, and then translate to what we mean in the context of this paper. So imagine a population of Republicans and Democrats, red versus blue, and the red versus blue really just signifies that they have different prior beliefs about something. The question in an echo chamber, about an echo chamber, if there is an echo chamber, is do they choose to see the same information with respect to forming that belief? So in a classic political echo chamber, you'd see, Republicans would be more likely to consume more right-leaning news sources. Democrats would be more likely to consume left-leaning news sources. And as a result, this is kind of one of those explanations for why political disagreement is so persistent. Now, thinking about investors, we can draw an analogy, but instead of labeling the red as Republicans and the blue as Democrats, we can label the red as bullish opinions or optimistic opinions about Tesla, and bearish opinions about Tesla would be signified by blue. Our question is, do the Tesla bulls tend to consume bullish information about Tesla, and the Tesla bears tend to consume bearish information about Tesla? We're not going to be singularly focused about Tesla, but we're going to think about these kind of stock level echo chambers where I have a stated opinion that I am bullish about a particular stock, and then subsequently do people then source information that reinforces that pre-existing view. So just to relate this a little bit more to the literature, an echo chamber is a combination of two big ideas that have existed kind of more broadly in social science. One of these is selective exposure, which is any systematic bias in how you select information or source information. This is bias sourcing for any reason in the broader literature. Another one, which we're a little bit more familiar with within finance, is that of confirmation bias. And kind of the classical perspective is that this is biased interpretation of information, or biased, like how do you seek or interpret information in ways that are partial to existing beliefs, expectations, or hypotheses in hand. Now, confirmation bias is broader than like my choices to source information. It can also be an information processing bias where I interpret the same information differently. We in this paper are going to be focusing on the sourcing of information that is consistent with your prior beliefs. And we think that this is actually a very important refinement on just confirmation bias broadly. And we think we have specific evidence to this point. So echo chambers is that intersection between selective exposure and confirmation bias. So question right off the bat, would it be surprising to find that echo chambers in financial markets? We think yes. The reason is that in markets, forming correct beliefs or unbiased beliefs about prices is valuable. Even if you have a particular belief going in, you should want to consume value relevant information irrespective of prior beliefs. Maybe you don't want to consume all the information, but it's not clear why you would want to bias it toward your previous worldview. This is not true for other settings in which echo chambers have been studied. There's no immediate personal incentive to be correct in politics, beliefs about science, religion, or brand of pickup truck. By contrast, if you form incorrect financial beliefs, that can be very costly in terms of the investment decisions that you make based on an incomplete picture of the market information. So how do we measure echo chambers? We turn to StockTwits. You can think about this as Twitter for stocks with a few extra levers to pull. I'll talk about those specific levers and what they bias. We are going to examine the StockTwits universe of approximately 400,000 users who contribute more than 33 million self-labeled bearish and bullish posts to this platform. And the key is that we're going to be able to see which users choose to follow which other users. And the choice of following another user is an information sourcing choice. If you follow someone on Twitter or on StockTwits, that places their future posts into your news feed, and you're basically thinking about this as I'm going to DVR this person's thoughts. So if we see someone who is a Tesla bull, who tends to follow other Tesla bulls, that is an information sourcing choice that biases their future information set toward the content of that choice. So we're just going to then look at the news feed that flows from these choices and then link this to market outcomes. So what do we find? We find strong echo chamber effects. These self-described bulls are 5 times more likely to follow a user with a bullish view of the same stock than self-described bears. And it turns out that if you flip it, self-described bears do the same thing. This is true for professional investors, though to a lesser degree. It's twice as strong for those who actually trade, which is our proxy for having skin in the game. And it's stronger on news days, which kind of gives a reason for why you would see persistent disagreement around these kind of news announcements. We see that this contorts the news feed in a particular way. If you look over the next 50 days, bulls will see 62 more bullish messages and 24 fewer bearish messages than bears about that same stock. And when we take it off of StockTwits and say, okay, let's use the measures at the stock day level or stock user day level to try to evaluate like how do echo chambers relate to market outcomes, we see that stock picks made by individuals in echo chambers exhibit worse ex-post stock returns. And in stock days that have more echo chamber behavior, more indicators of this, which is we're going to measure as information siloing along the social network, we're going to see more trading volume. So there's more trading, and that trading has the features of being worse stock picks. So let's go ahead and dig in now that you know what our main findings are, and I'll tell you about kind of how we connect the dots and give you some more precise details about the tests. So kind of broadly, we're going to ask the question, do we see echo chambers in the data? But it's going to be important for me to tell you about, like, well, what did the data look like? So first, just like, if you haven't seen StockTwits before, it looks like Twitter plus some extra stuff that's going to be like super useful for understanding how what's going on in the minds of the investors who are contributing posts to this network. In particular, unlike Twitter, there's a clicker where you can indicate that you are bearish or bullish about the stock. So we don't need to like sort of do a high dimensional like sentiment analysis and have confidence in that. We just need to sort of trust that the users when they click this are expressing their genuine opinion. Now it's not a trivial step, but this I now have 4 papers using StockTwits, and we're always asked to validate some aspect of this. We have validated this in a lot of different ways. It looks like when people use this clicker, it is a genuine signal of their beliefs on average, more often than not. So here's an example of a post, so you can kind of see the information content that we'll have. We can see the day that it's posted, actually the time. In this paper, we don't use the time as much, but we will use the daily frequency of the posts. We can see the user and the username. We can track that back to their profile information, where they can declare what their level of experience. We can also see that user and who that user follows and when, relative to when they make these posts. In addition, we see these self-labeled declarations of bullish versus bearish. So it's actually very salient on this platform that Todd Sullivan is a TPL bull. And so that's just very easy for people to infer from the posting. Here, the cash tag was actually an innovation of StockTwits. It migrated over to Twitter. So if you ever see this $ and then the ticker, that cash tag indicates the security that they're talking about. We're going to focus on tweets that are about a single cash tag. There are tweets out there that are about multiple cash tags, but it gets sort of ambiguous about which stock they're talking about. But we'll just to kind of make sure that we're focusing on that we can attribute that we can say, like, here's Todd Sullivan. Todd Sullivan is a TPL bull. That's unambiguous from this tweet, and so we'll focus on tweets that look like this. So our sample runs from 2013 to the middle of 2020. There were some kind of crazy Robinhood shenanigans. I think StockTwits got a little spooked. And so that's June 2020 is when our API key stopped working. And they didn't really tell us why or give us any notification. But fortunately, we collected the data up until then and are free to use it. We keep symbol IDs with 2,000 messages. Well, what's a symbol ID? A symbol ID is either a stock or another symbol that people might talk about, like Bitcoin or SPY. We have about 1,000 stocks and 130 other symbols. Whenever possible, we'll use the full set of symbols to what people are assets that people are talking about. But we will, when we go to the market tests, restrict attention to assets that have stock market information available in CRISP. So we'll keep only single symbol sentiment stamp messages. The sentiment stamp is important in our case because it is a signal of what that user believes. And so it's important to sort of know that by sort of classifying the focal user who's going to be doing the following, as well as the users who are being followed. And so we're going to be looking for a match between that. If someone was bullish but didn't click it, that's not going to be salient enough for us to sort of reliably put into, well, that was someone to follow. So when we do this, we're going to have 400,000, give or take, users posting 33 million messages. To remove the influence of users who just get excited and post a bunch of times in one day, we're going to roll everything up to the user symbol day level, and we'll have about 14 million observations. On another fact that's going to be useful for us is that on StockTwits, sentiment is persistent within user. That's going to be helpful for us because it's going to be both this, we're going to use this to identify if someone is bullish, and then subsequently when they make following decisions, we're going to be kind of assuming that they're still bullish, and that their decisions reflect that initial bullish sentiment. The other aspect is for sentiment to be persistent. If you're going to DVR a program and you think this is going to be a Tesla bull program, well, it's useful if sentiment is persistent to kind of make that a more reliable signal of the information that will be coming in. So both aspects, it needs to be persistent. We show in the paper it's actually persistent on both the bullish and the bearish side. So let's talk about the main result. Remember, we're looking at the choice of whom to follow. So to follow another user is to sign up for that information feed. To the extent that's biased toward bullish versus bearish information, that's kind of how we're going to make our inference. So in the subsequent figures, we're going to present we're going to identify, declare bulls or bears about a stock on a particular day, and we'll call that the event date 0. And then we're just going to count the cumulative number of follows for bulls versus bears and show kind of how this spreads out and widens over time. So a user is going to be a bull on a date if the user stamps that message as bullish about the stock S on date T. And this strategy is akin to seeing someone declare themselves as Republican or Democrat today, and then seeing if they set their DVR to record Hannity versus Maddow tomorrow. So when we look at this, declared bulls are significantly more likely, 5 times more likely to follow other declared bulls about that same stock than are declared bears. And this spread widens rather significantly. There are more bullish posts on StockTwits than there are bearish posts. So we wanted to make sure that this wasn't just like people are more likely to follow bulls, So when you flip it and look at someone who declared as a bear at date 0, you see that actually the people who declare as bearish are actually more likely to follow bears than are people who declared as bullish. And so that this kind of reinforces that idea. This picture it's not kind of super, think of this as sort of plotting the raw data on following. Next, I'm going to try to convince you that this isn't really explained by like people just purely being optimistic or stock day level news, and etc. So what we do is we actually do an analog of that figure in a regression specification. What we do is we look at the following decisions in a window of time after a person declares as bull versus bear. We have an indicator for whether someone declares as bull, and this indicator for whether someone declares as bull, the omitted category is going to be if they declared as bearish. So it's going to be basically drawing that comparison between those two lines that you saw in that figure. So this coefficient beta 1 is going to tell us the degree to which declared bulls follow other bulls more than do declared bears. And we're going to, in all of our main tests, kind of do an indicator for whether bull follows are greater than bear follows between dates T and T plus K. We'll consider different windows for this, but it doesn't matter if we just said like bull follows or bear follows, and like the specification isn't really sensitive to form. The nice thing about putting this into a regression is that we can absorb person-level heterogeneity, i.e. optimism or pessimism. We can also absorb news. So at the stock day level, we can throw in stock day fixed effects to absorb whether like news led people to be more optimistic versus pessimistic and led to this this correlation. So this specification, when we have these stock day fixed effects, and all of our specifications will have this, we'll compare someone who declared bull versus bear on the same day, and then look at their subsequent following decisions. After netting out how optimistic people were on average about that stock on that day. So it's a pretty tight identification of this echo chamber behavior. So here what we can see is if you just look one day ahead, there's a pretty significant increase in the following rate, about 40% of the mean following rate at the daily level. You can do this for a window 1 to 5 days. We can also add user symbol fixed effects, which then would be identifying from people who've changed their mind. That doesn't completely explain away this kind of echo chamber behavior. So it's not just a person stock phenomenon. The interesting thing is that as we kind of move the window farther and farther from that focal date, the degree of the echo chamber declines, and so we think that kind of helps us with some of the alternative explanations that you might have rolling around in your mind. So one other thing to just kind of note that this is the following decision. We've also looked at the content of the news feeds and the degree to which people like posts. These two are biased in the direction of the user's initial posting, and so it looks like the information they actually see in their news feeds is more bullish if they were initially bullish, and they tend to interact with those posts as well. So next, just want to kind of outline a couple of features of heterogeneity that we see in our setting. When we look at investor experience, it's natural that if this is a behavioral bias, professionals would exhibit it less. And that is indeed the case. So when we interact those self-declared experience categories from their StockTwits profile, we see that novices exhibit this phenomenon much to a greater degree than do professionals. But interestingly, professionals are not immune to it either. We thought, well, maybe skin in the game would attenuate this. So we did a little textual analysis to see if people actually held the stocks or sold the stocks around the same time. And we actually found that people who had more skin in the game, declared trades about these particular stocks, exhibited this behavior to a greater degree rather than a lesser degree. And then when we looked at news days, particularly earnings announcement days, we found that echo chambers were more pronounced around these news days, which provides a perspective complementary to the classic Kendall and Pearson just differential interpretation of the news. Here, we're showing that actually people dig themselves deeper into echo chambers around the arrival of news, which it could make sense in a psychological perspective if you are kind of trying to mitigate that cognitive dissonance that that maybe the news is unsettling to you. So you put more of a buffer to that. So now let's look at and connect this to market outcomes. We're going to do this in two ways. Number one, we're going to ask the question, is it 5 minutes remaining?
Yes, exactly. That's what I was going to say.
Great. So now we're going to look at, ask the question, do users in echo chambers make worse stock picks? So we're going to, the way we're going to do this is we're going to use the stock user day level. And we're basically going to ask the question, do declarations on StockTwits, like how did those perform in terms of predicting abnormal returns in a window going forward? And so we'll ask kind of if someone makes a bullish declaration, and then we'll just absorb kind of as much as we can with fixed effects without kind of absorbing their declaration themselves. We're going to include day fixed effects, stock user fixed effects, and stock month fixed effects. And then what that's going to give us is a baseline underperformance gap. This coefficient on bull will be how much does following this this bullish declaration by this user contribute to underperformance or overperformance. It's going to turn out to be underperformance if you follow the opinions of people expressed on StockTwits. Then what we'll do is to capture the declarations made in echo chambers versus not, we're going to interact this sentiment indicator, this bull indicator, with a measure of how much signal diversity that user sees in their newsfeed. So if their newsfeed is more diverse in opinions about this stock, they're in less of an echo chamber. If it's more concentrated, they're in more of an echo chamber. And the idea is that we'll be able to then, through looking at that interaction, see what is kind of the cost in terms of the performance of stock picks made in an echo chamber versus not. When we do this, what we find is there's an underperformance gap for a 5-day window of about 1.5%. And about a third of this could be chalked up to the sort of variation in the degree to which people are exposed to echo chambers. Interestingly, when we actually include the interactions with novice, intermediate, and professional, that doesn't explain away this phenomenon. It explains variation, but it doesn't explain this kind of underperformance gap and as it relates to declarations made in echo chambers. So we think that this is pretty useful evidence there. We also see kind of nice dynamics if you look day by day that kind of both that interaction coefficient and the baseline underperformance gap both converge to 0 after a while. And then lastly, there's a key implication. I started with the motivation. Say, echo chambers lead to more siloed information. Bulls are going to have a different set of information than our bears. And the characteristic of this information silo is that I'm going to be kind of less uncertain based on the information content. It's going to be more concentrated around my prior belief, but my information set is going to be different from yours. So we're going to measure kind of both of those things, like whether we have kind of people tend to have concentrated news feeds and whether their news feeds disagree with one another. One of the first concentrated news feeds is called received uncertainty. It's when that value is low, you're less likely to be in an echo chamber. When my news feed sentiment disagrees with your news feed sentiment, that's what we call high received disagreement. And when that's high, you're in an echo chamber. So we're going to measure both of these markers of echo chambers, and we call it information siloing. And we're going to then just kind of ask, well, how does this relate to trading at the stock day level? And so when we do this, what we find is actually above and beyond just regular disagreement, the disagreement that people have on the social network. These explain a pretty substantial amount of trading. Disagreement explains quite a bit of trading. Here you can see the sender, that's what we call sender disagreement, to distinguish from like disagreement in the information that I see. And both of these measures kind of point in the direction that there's more trading when information is more siloed. And the magnitudes are fairly similar to disagreement itself. So above and beyond just pure disagreement, information siloing from echo chambers seems to lead to more trading volume. So in conclusion, we find that people source information that confirms prior beliefs in a financial market context. We think this is surprising, given that you can lose a lot of money by forming incorrect beliefs. And it's not true in other settings where you'd be as surprised about this. So we think that this is an important contribution to the general literature, but also important within finance, especially because it's reflected in market outcomes. These declarations perform worse when they're made in echo chambers, and people are trading more intensively. So we think that this is an important perspective to keep in mind when thinking about financial markets. So thanks for your attention. Looking forward to Umit's discussion.
All right, thank you so much, Tony, for this perfectly timed presentation and a lot of insights. And as we move over to Umit's discussion, let me just remind everyone that the chat is open for your questions, and we'll proceed to Q&A as soon as Umit is done. So please, Umit, you have 15 minutes.
Can you see my screen?
Yes.
Oh, perfect. Okay. All right. Hello, everybody. Thanks for the invitation to discuss this paper. One word, this is a great paper. Okay, so my comments are basically is going to be very just praising, and I think just like we need to do more work using this data, and the overall research question is very interesting. But before I sort of get into details, this is something that I saw in my echo chamber yesterday in tweets. Basically, when you look at the paper, just you sort of try to understand whether the stuff is interesting, and whether or not what we describe as our findings kind of fitting to what we really find, and and there's also the point where our findings lie. Okay, so so this paper is right in the middle. It's super interesting, and they do a really good job of just describing what they do, and my discussion is going to be more about another paper, if I were to have this data, what would I say, and how would that be a little bit different than this paper. So I'm sort of trying to start from scratch, if I had this data, and if I really want to analyze the echo chamber, would I execute the paper in the same way? I mean, the answer is largely yes. But before I start my discussion, we need to sort of understand and internalize this concept of echo chamber. Okay, so it's going to affect our all parts of our lives, from politics to religion, from the investment. So it seems because of social media, we seem to self-select into information sort of sources, and we seem to be sort of getting affected by these information sources a lot. So as a result, we really need to understand the implications of being or choosing to be in an echo chamber, and how is that going to affect our sort of behavior going down the road. Okay, so this is a super interesting paper. The area is very interesting, and the paper is kind of one of the first in this area to sort of bring this to the light. So for that reason, I think authors need a big applaud. Okay, so what the paper does is with one word, just bulls are more likely to 5 times more likely to follow a user that has a bullish view compared to the bears. So which is kind of the definition of echo chamber from the author's point of view. And as a result, just other than just analyzing this StockTwits environment, authors try to relate the formation of echo chambers to some of the outcomes we see in the markets, such as does it lead to higher or lower trading volume? How do the returns look like? There's implication about this persistent persistent disagreement on the prolonged mispricing patterns, perhaps. So there's a lot to say, like once you sort of put a structure on the information set. I'm going to talk about like StockTwits. Like some of my comments are about like understanding this echo chamber, which may or may not be within the sort of domain of this paper, because the paper is already like very long. But for those of us who want to investigate this this data set or this environment, I think this is kind of like gold mine. Okay, and then I will have something to say about the the connection between these two sort of like the parts of the paper. So my first comment is this 5 times more is kind of I think it's super interesting in the sense that unlike the stock market where short selling may or may not be sort of constrained for some of the participants, if this is kind of an sort of constrained environment, like I would expect this to be like one-on-one. Okay, so I'm not sure, but just like my prior would be 1, and this thing being 5 times more itself is very surprising. Tony was trying to make a case that I mean the fact that we see the effect of, or do we see the existence of echo chambers in financial markets should be the null. And like whether or not it exists is kind of important, which I agree. But like seeing this 5 times more is also interesting. I think just like we need to put this into some context. So I don't know what will be the baseline, but if we were to sort of investigate other settings where like optimist people declare their optimism, or like just like if I'm a really the positive person, do I go and find other positive people who are reinforcing the same view of the world? Is it 5 times more in other settings? So I think it will be important to sort of put this into context if possible. But other than that, I think the magnitude is really striking. So I guess like for other discussions of this paper, perhaps like I don't know how many of them did, but I did sign up to I mean I was a member for some time ago, but I signed up for the first time again with a different username, and I said just look Tesla, Elon, you are going down. I said look I'm bearish a little bit. And then boom, like I got 2 sort of like responses, like how much did you lose today, and depends on how you look at them. So I get some feedback from other users who happens to be like bullish on the stock. So the point here is, just as soon as I declare myself, initially I declared myself as bull, then I turned into bearish. But, without even following many people, I had this watch list. I had this stream of news, which seems to be dominated by the bullish people of the Tesla, and which sort of makes me think, like, what is the effect of like the algorithm that StockTwits is using, and like what kind of information is being pushed to me before I declare myself, and to what extent this initial subset is being augmented by the people that I am really following. Okay, so in a way, even within this, the universe of the news that I'm getting from StockTwits, I see this as kind of like if you really get your information from StockTwits, there will be a part where the algorithm is going to push you with or without some agenda. On top of that, the people that you are following, and it's the combination is going to be your information set. So like, it's going to be large or small, like can you sort of just digest the old news at the same time? And if you follow a lot of people versus like few people, these are all empirical questions, I guess, like future papers can see. If you have a large amount of people following, then you would expect each of these like influential people to affect your decision different ways. So I guess like there could be some other heterogeneity that could be investigated using this data set. And how does your information set, this information silo, vary over time? That this is also endogenous, but again, like this is something that I guess like one can do by looking at the textual component of the news. So like there is this this notion that Tony was talking about, the information silos being different for different people, but the paper doesn't really measure that. Perhaps like it's really noisy to try to understand the information silos. But I guess like future work could be done on like quantifying these information silos, because this is one of the places where we really see what kind of total information set you are getting. Like are these like within like 100 words or 200 words, how many people are really disclosing some coherent view of the company? So it will be really interesting to see the content analysis of these messages. So another thing sort of that makes me think about this echo chamber, like they are more likely to be created, or they are more likely to exist during the heightened uncertainty. So when you think about the theories of trading volume and uncertainty, these are like kind of endogenously sort of feeding each other. So on top of that, you bring in a concept like echo chamber, which also starts getting formed more during the high uncertain times. These are kind of endogenous moving, okay, all three of them. And then, just which also allows us to maybe like create some experiments. So we cannot really change the trading volume or the uncertainty, but we can change the echo chambers perhaps with the help of some experiment through StockTwits. So this is really a gold mine again for people like trying to understand these types of concepts. We can change the news feed, which is kind of similar to Anastasia Feding's paper, but in a sense, like we need to really understand to what extent volatile times are sort of influential in the creation and expansion of these echo chambers. Another thing, like with the echo chamber, remember, like this is kind of a decision. So in a way, one can think of this like there are few people, like if you are like 10,000 people in an echo chamber, there'll be one or two thought leaders. There'll be like super spreaders, like just people really try to say, hey, like like Tom Lee is thinking about stock market going 5 times in the next year, versus like some other person who's a like notable perma bear, just like there will be super sort of followers of that people. And then we will have followers, like most likely the type of people that the paper is looking at. And there are some lurkers, like me, like 5 days ago, so I was just looking around and I will not really do anything reasonable there. So the idea here is, so when you think about echo chambers within the in other domains, the thing that people are sort of trying to understand is it starts with some opinion, then it leads to an extreme opinion. Like the guy who has the most extreme opinion starts sort of taking the herd to some place, and as a result, it gives an environment where the intensified opinion expression starts becoming really strong in the echo chamber. So like, in other domains, that's basically a defining factor in echo chamber. So I didn't want to understand like, how does this also exist in, when people talk about stock market or a given company. So how does extremism evolve in a stock market? To what extent, these followers are kind of change or like kind of like start like following more or not as the extremism in the stock it becomes like more pronounced in the echo chamber. I think these are like interesting things that one can understand after this paper. So I'm sort of trying to make it clear that I think this could be a little bit beyond the scope of this paper, but going forward, if we really understand this type of a concept, we need to sort of understand the information that's being spread through these echo chambers. So that's basically for the first part of this echo chamber identification in this data. So coming back to the financial market component of the paper, so there's a very interesting footnote number 6, which tries to sort of tie the echo chamber to financial markets. This is an empirical paper, it's already long, but in a way, it sort of describes the view of like a market, sort of the type of a market where echo chamber can lead to a higher volume. I guess like, we need some more like going forward. So I would expect, just like different features of echo chambers to be echoed, like, or kind of modeled explicitly. And then, how does it help sort of understand bubble formation if echo chambers are really reflecting the extreme views? So does it really help understanding hanging on to losers or the winners? Kind of like, there is an aspect of disposition effect that can be linked to echo chambers. It definitely is related to cryptocurrency trading, where people are religiously sort of like tied to like, an asset which may or may not have any underlying phenomena. So again, just going forward, this footnote 6 can lead to different types of papers. I think it's really nice that authors are trying to create a link between trading volume and the echo chamber, but this could be more like richer, and it could lead to different type of theories in other papers. So I guess like, if there's anything that I will sort of push authors or like some other people in this area, is to really quantify how echo chamber is different than other information sort of theories, where there's a relationship between like how we think about the information, how we interpret it, how we compile them, as a result, like how we act on it. Okay, so that's basically I think is a very nice feature of the paper, which I think we should sort of like pay attention to. Like Tony said, like, you know, that this StockTwits represent the financial markets. You know, he has a couple of papers in terms of sentiments relation to market outcome. So I would think, you know, this environment is really kind of interesting. But there are other places where people form opinions, you know, and the opinions cluster, like the message boards and investment clubs, you know, going back to 2005 and 10s. So this is the norm now, perhaps, like that we live in. So I think it's really important that to sort of supplement the findings of this paper in other places where such echo chambers can be formed. So so right now, like, you know, StockTwits seems to be one environment in today's sort of market. So I think, you know, just there is room for like more about this phenomenon. So overall, I think it's a very interesting paper, very useful set of facts, like especially from this unique data sets. You know, it does, you know, deliver what it says at the introduction. I think it opens doors to potential other interesting topics. So that's kind of like, you know, my view of the paper.
Okay, thank you
Thanks.
so much, Umit, for the discussion. That's spot on time as well. And Tony, would you like to take a couple of minutes to respond to any of Umit's comments?
Yeah, mostly just to say thank you very much for some thoughtful comments. The couple of these comments we've been working on a bit. So I think, like, I think it's like there's some useful sort of thoughts that kind of help us sort of think about this. The big one that I think is like super important is that kind of footnote that you elevated. That I think, like, thinking like how does this help us kind of think about disagreement models, echo chambers embedded in this? Like, what more do you get from this? One of the sort of interesting things that came out of the past year was for example, the GameStop episode, and this motivated a fair amount of research. There's a very interesting paper by Lasse Petersen on basically theoretically modeling the GameStop episode. And he sort of identifies kind of a model in which echo chamber behavior coexists with like other stuff, and it kind of exacerbates some of these trading frenzies, and kind of shows and traces through some of the logic of this. That paper came out after we posted and submitted our paper, so we weren't really aware of it, but like it actually turns out that like our findings, when we interpret them with respect to this, and then think about some of the dynamics of like how beliefs either intensify or attenuate in terms of market conditions like volatility, like what you were talking about, like that it really actually fits really well within the direction that paper is going. And that paper also has this feel of like kind of opening up sort of lines of inquiry. So I think there's a lot more that we need to understand about echo chambers generally, like on social media, but then also these other venues where you might see them. But then also like how the social media component sort of facilitates some of this as well, which we don't speak as much to that, but I think that would be interesting, like an interesting direction for people to take some of these ideas as well. So just really just thank you for the thoughtful comments, and we're working on them, but like that, if we presented all that, it'd just be like a paper that's guts were splayed out. So we presented the previous version. So, but these are like super helpful for helping us think about what choices we need to make to tie down the edges of the paper.
So let me thank Tony and Umit for their contributions today, and it's great to be back on the road with the webinar series, and it's been great to have you in the first events this season. Thank you very much. And
Thank you.
we meet next time at the end of September on the 29th. So stay tuned.